So it's 12:15, and if we want to have lunch at 1, we need to pay attention to the next session, which is a discussion on the 2020 Global Economic Outlook. Before that, I just want to take a couple of seconds to, first of all, on the behalf of GIC and the board, to thank Don Rissmiller for his amazing leadership during the past 2 years, and to tell him that I'm very nervous to fill these shoes. So thank you very much, Don. I also want to thank Jill Finito and Colleen Murphy for organizing this in such a seamless way. Even though we're just halfway through, I do believe that it is an extremely wonderful session event. And again, on behalf of the board, we want to thank you for your efforts. And now, I would like to introduce the next panel. As I mentioned, it is the Outlook for 2020. And we have Michael Drury, who is now Vice Chair of International Affairs, programs. And again, we want to thank you for all the efforts that you have put into the GIC. And he will be speaking on I guess, Chinese outlook particularly. And also Don Rissmiller, who is going to speak about the U.S. economic outlook. So if you both could please come to, I guess, the table, and then we'll take it from there. Thank you.
Happy to be here today, but I write a weekly newsletter, and the first line this week was that in economics, politics, and comedy, timing is everything. And my presentation is on the China outlook, and it was going to be on trade. So yesterday, while I was on planes for 24 hours trying to get here against the Army-Navy game, they concluded a trade agreement. And so, thank you very much. Are there any questions? Let me go quickly through my presentation. 3 points I'd like to make about the trade agreement, whether it happens or doesn't happen, what the impact will be on the economy, and then just a very quick look at where China is, and then basically I'll turn it over to Don, and then we'll take questions at the end. Join. The 3 points on the trade agreement are, first, the trade agreement is more important for everybody else in the world than China and the United States. And that's because if you're in China, about 1/4 of your trade is with the United States. It's actually down to about 18% right now because of the fall off in trade. If you're in the United States, about 1/4 of your trade is with Pacific Rim, about 20% with China. So for both of the participants, it's affecting about 20% of their trade. But as you can see from those two charts, for everybody else, it's 25% to America and 25% to China. So for everybody else, it's 50% of their trade. And this is why Japan and Korea are having a trade disagreement at the same time that China and the United States are having a trade disagreement. That's why for Germany, there's a manufacturing recession going on. So reaching this agreement, if it has been reached, is going to be more important for the emerging markets in Europe than it is for either of the two participants. The second is that part of the reason I felt that we would get to an agreement, or no more tariffs at least, was that you've reached a point where all the low-hanging fruit is gone. When you start any process, you always pick off the easy stuff first. So we picked on washing machines and solar, which we don't manufacture in the United States. And then we went to steel and aluminum, which we don't manufacture in the United States. And then we went to $50 billion of trade. And we actually had to back off on that because we couldn't find $50 billion that the manufacturers in the United States would agree to. And so many of them applied for exemptions that we had to do it in 2 tiers. First 34 billion, then another, or 36 billion, then another 14. The bomb was when in September of last year we dropped the bomb on $200 billion worth of trade, and then we've escalated since then. And it was only since September last year the trade war really had an impact. And you know, so when we got to where we are now, the September tariffs and the promised December 15th tariffs, the trick there is that those tariffs have much more of an impact on the United States than they do on China. And that's because the goods that are in that final 300 billion are largely like the top three lines here, toys, sports equipment, footwear, textiles, and clothing. They're 90% made in China, which means you don't have any options. So the Chinese are just going to tack on whatever the tariff is and send it along, and you're going to pay. Or they're in those bottom two categories, final goods and capital goods, where essentially a large part of them, this is like Apple phones, are manufactured in the United States with some value-added content from chips. And so again, it's not the Chinese that are going to be paying these tariffs. In fact, it's probably the South Koreans, the Taiwanese, and the Japanese, and to a lesser extent the United States and the Germans, because they're the ones that ship those parts into China to be reassembled and shipped back out. So again, if a trade agreement is going to be reached and those areas are not going to be touched, who is signed the sigh of relief? Well, the U.S. customer, because he would be the one paying, the Federal Reserve, because they're the ones that would have to be tightening monetary policy when inflation rose by 1%, because you pass through costs on such a large scope of consumer goods, and the rest of the world, because they're the ones that we're going to have to pay the tariffs. The final question, and to me it's the most interesting question, is so if there really was a trade war and it really did get bad, and you're an American American company or a multinational company doing business in China, where would you go? Everybody's talking about Vietnam as the big winner from this because everybody's moving to Vietnam. So what I did is I went through and I looked at all the countries in the world with more than 25 million people, because it's no use talking about Ireland and Switzerland because they don't have enough people to matter. And then looking at them based on per capita income to tell you where they were on the scale of productive capability and then where you would go. And the first page, these are the people who are currently losing business in the world today because they're too high cost. And you start with the U.S. Northeast and West at roughly $68,000. Then you drop down to Australia, Midwest, Northern Europe, and the U.S. resource sector, the oil patch. They're all at 56. Well, the first thing is just look at the size of that gap, $68,000 to $56,000. And as you continue down, the lowest cost producers in the West, Italy, South Korea, Spain, Taiwan, they're all in the $30,000. They're all quite expensive. There's 1 billion people on that chart that you're looking at. That used to be the global economy. Then these guys called China came in. And China right now, Greater Shanghai, that's Shanghai, Zhejiang, and Jiangsu province, Southeast China, which is basically Guangzhou, and then Jing-Jin-Ji, which is Beijing, Tianjin, and Hebei province, and Shandong added in. Those three areas currently operate in the $10,000 to $15,000 cost range. In other words, half of the lowest costs in Europe. And that's where all the growth has been. And those three areas are about 500 million people. Their competition, Argentina, a lot of you looking to expand there, right? No? Okay. Poland and Russia, another two big end markets right now. Turkey, Brazil, there's some action there. Malaysia, not until you get down to Mexico is there a real winner on that list. And Mexico is probably the country that will win the most from the trade war because businesses that do come back are not going to come back to America. They're going to come back to Mexico where it costs you about $10,000 instead of about $50,000, $60,000. Below Mexico, though, you continue down that list, and the next group of people, I mean, if you're not going to play in any of those, almost everybody else is either in Latin America or in China. And Latin America's got as many problems these days as China does. So, you know, where are you going to expand? The places that people are talking about, Indonesia, the Philippines, Vietnam, the ones in blue there, well, their competition is all the guys in dark black. And all those guys in dark black are India. And the bottom line is India is just a lot bigger than those countries and a lot cheaper than those countries. And it's starting to get its act together politically. So I think the answer is if you're going to move from China, you're going to skip right through the ASEAN. You'll do some business in the ASEAN. The ASEAN's already a bit too expensive. You go right to India. And the number of people ready to move to India today is it's nobody. I mean, so what's happening is people are deepening in China or transshipping through Vietnam, Korea, Japan, other places. But people are waiting to see what the trade deal is, and so am I. But the trade deal appears to be that we will cut our tariffs in half. Now, in half to the president means from 30% to 15%, and keeping it 15% on the ones on the most recent 112 billion, and cutting in half to the Chinese means cutting in half. So there's still some disagreement there. And the other half is buying $50 billion in agricultural goods, which to the president means $50 billion in agricultural goods this year, and staying at that level. To the Chinese, it apparently means $26 billion more this year, because they already bought some, and maybe $50 billion next year, but they're concerned at what price, and is it a volume agreement, or is it a cash dollar value agreement? So there's still some things to be worked out, and historically that has shown that maybe you have an agreement, maybe you don't, but we'll see. So very quickly, where is China? Well, the Chinese economy has slowed down. It's growing, I would guess, 4 to 5%. They say 6, but they always say 6. Keep in mind, they always say 6 because in China the economy is not measured by how well businesses are doing. They don't go around and add up businesses the same way we do in the United States. It's basically like a military budget, where you were assigned a 6% growth budget. You either spend it or you don't spend it. So guess what? You spent it, whether you did or not. And so you report that you spent 6%, and they report that you spent 6%, and growth is always 6%. So what is growth actually? Well, they're expanding credit, which means they think it's slower than 6%. As you can see, that credit line is leveling off, which means they kind of think they're all right. And the lead lag is that it takes about 6 months for that to show up in the rest of the world, and we think that's where you are right now. China tried to recover here. This is September when Trump dropped the bomb. They tried to recover here. This is March when he expanded. They tried to recover here. This is May, and now they're trying to recover again. If there is a trade agreement, this time they will recover. If there's not a trade agreement, we slide back one more time. But until China turns around, the rest of us aren't going to turn around, because you can see China leads that rise each time. Other indicators, China car sales. Everybody's looking at China car sales being down 15 months in a row. They are year on year, but if you seasonally adjust the data and look at it sequentially, they've been in recovery pretty much since February. That seems to have leveled off with the credit, so maybe this is as good as it gets in China right now, but it's not a disaster. Average price for residential buildings, it's running about 8%. That's well in excess of nominal growth in China, so that's a plus, even though it's come off the boil because credit has come off the boil. Equities, not so much. They had their rebound and now they're running sideways. This is not updated for last night where they had the biggest bounce in a long, long time, so maybe they're clear. We'll call it the Li-Ka-Shang Index, trade in railroad freight and electricity. Both of those look up to sideways. They're not great, they're not terrible. That's where everything in the Chinese economy looks. And then imports and exports, they're down. The thing I look at is Chinese exports are down 1.1% to the world. They're down 23% to the United States. That means they're up 3% to everybody else in the world. Nominal GDP globally is about 5. So if you're getting 3% growth against 5% nominal growth, it's not perfect, but it's not a disaster. So the trade war has pretty much been a U.S.-centric thing for the Chinese. Their PPI, it's really hard to see, but that's going up. PPI is the most important indicator in China because it determines, along with the yuan, it determines China nominal GDP denominated in dollars. Since real GDP doesn't change, PPI dictates the change in nominal GDP, and the yuan dictates the change in dollar value. And the reason that chart's important is because that chart determines the movement of every commodity price on the planet. This is the price of crude oil, and it roughly follows that pattern. This is copper and soybeans. Soybeans not so much, but copper pretty much follows that pattern. And that's because China's the #1 purchaser of commodities everywhere on the planet. They account for about 50% of the market. When they have money, they spend. It looks now like 4% nominal growth, 2 to 3% inflation, so 7% nominal growth in Chinese economy. And the yuan is getting a little bit weaker, which weakens their buying power, so that's 5% for global GDP. That's about where global GDP is. I would say China is not either an add or a drag on the global economy at this point. Is it a disaster that China is growing at 4 instead of 6? Well, you know, India was growing at 8, and now it's growing 4. The United States was supposed to grow 3, now it's growing 2. Europe was supposed to grow 1.5, and it's growing 1. Everybody's disappointing. I'd rather be disappointed at 4 than disappointed at 2 or 1. That's my story, and I'm sticking to it. Thank you very much.
Thank you very much, Michael. So I'm going to talk about the U.S. economic outlook. And there are a number of things that had to go right this past week. I think the good news is a number of them, at least from a risk point of view, seem to have taken the path of less near-term risks. So we had the UK election, we had the FOMC meeting that addressed some of the repo issues, we had the China trade story. So it doesn't mean everything is good, and there's still some data that have been underwhelming. If you look at GDP tracking estimates like the one the Atlanta Fed does, those have been choppy the last month, fluctuating between 0 and 2%. Jobless claims had a big rise this week, but some of that looks to be a seasonal adjustment problem with the Thanksgiving holiday. Real disposable income, if you look at the October release, was weaker. Some of that was in the farm income piece, so this ties into some of the recent trade issues. I'd say for 2 years, economists have been telling the White House trade would slow growth, and that mattered 0. But you get some farm bankruptcies, and you get some changes in food prices in China. Those type of tangible items do seem to matter. Holiday sales have been mixed. They seem to start out okay on some of the cyber indicators, but some of that spilled into December. So November retail sales were actually somewhat disappointing. Some of that could be timing. We do have a shorter 2019 holiday season to deal with, so I'd say so-so on that front. Credit has generally been contained. If you look at the senior loan officer survey that the Fed does, there's a modest tightening of bank lending conditions in the fourth quarter. Some of this is constrained to energy. So if you look at where some of the issues are, there is a small pocket there. But generally, this has been benign. Corporate profits have been flat. So this comes out of the national accounts as well as some of the S&P data. So there's not a lot of robustness there. The trade war does seem to have mattered. We'll see if we get a weekend deal. But the manufacturing PMI new orders component is back down to its cycle low in November. So this is where it's a bit hard to get too excited. But I would describe our general forecast as a big sandwich. So it's bounded on the top by some of these things we just talked about. I think this is mostly going into the I, part of the C plus I plus G equation. This is holding back investment. It's also bounded on the bottom by the consumer. So with the labor market doing what it's been doing that we've talked about all day here with low unemployment, it's hard to get too negative. So we get sandwiched into a GDP forecast of 1.8% in real terms for next year. We'd say the odds of recession are something like 30%. But I do see transmission of monetary policy through the financial markets. I do think that's working. It still seems like monetary policy is transmitted through the stock market within a country and through the currency market between countries. And so you have policy responding that's enhancing market liquidity, that's supporting asset prices, that's flowing into consumer confidence. So it's hard to get overly negative on that front. This is a picture of fixed investment versus the CEO confidence survey. This just came out again this week on the weaker side. So the blue line is CapEx, and the red line is what CEOs are saying they think of their business, and that leads by about a quarter. I think this is intuitive. When CEOs are more optimistic, you get more capital spending. That big surge up in the red line was the tax cut, back to the beginning of 2018, and then the decline over the last year and a half has been the trade war. We're actually below where we were when we started the fiscal policy stimulus 2 years ago. So I'd say the least likely outcome here is you get a V bounce. I'd be surprised if we go back up to the tax cut highs on CEO optimism. I'm hopeful for a U-shaped recovery. If Worst case is you go sideways because we're going to roll right from trade to impeachment to election and make some of those transitions. So election uncertainty in 2020, I'd say, is real. I don't want to overemphasize it. Impeachment's happening right now. It's still a two-step process. I think markets have mostly been ignoring this for good reason because it's unlikely to make it through the second step. Employment in swing states, if you look in the middle of the country, has actually been a bit weaker. Wisconsin's going to be one of the most important states for this next election, and I do think that's why some of the farm income data has mattered. In general, we'd argue that the second quarter 2020 economic growth data is going to be really important for determining how this election goes. So an incumbent would have a natural advantage, any incumbent, if the economy is good, but it's probably not the data right at the election. It's probably a little in advance of the election. The stock market also is usually a good indicator. The stock market's rising the 90 days before an election. The incumbent has an advantage. If it's falling, the market's voting on some sort of change. So what I would say for sure is that sometime in the next year, it's going to look like we're going to have to price in the idea that both candidates can win. Whoever the candidate is on the Democratic ticket, at some point, it's going to look like they're going to win. Even if they don't, even if they do. Around conventions, you get big swings in polls, and so we'll have to consider some of these policies. If we wanted one statistic to watch, I'd look at the odds that the Senate switches parties, because to get some of the big policy changes, you probably need to sweep, and those have still been running below 50-50 currently. So a way to watch this, but in the meantime, it's going to be hard to get that big recovery in business confidence. So that's the top part of the sandwich. We don't have the I part of the equation working. It's tough to have an overly robust forecast. The bottom part of the sandwich is the labor market. So this is the employment growth rate on a year-on-year basis. We're still in soft landing territory here. So this looks like 1995, or more recently, that period around the Euro crisis, the shale bust in 2014. So far so good on this series. And then there is some market liquidity that's being created because of policy actions. So the blue line here is the M2 money supply numbers. The red line is the Fed funds rate. We're looking at them both year on year, and I think this is intuitive as well. You know, the goals of cutting interest rates is to get liquidity up. That is still working, and so the transmission of policy still does go through financial markets. So this chart here looks at S&P performance following the third Fed rate cut. The idea here is one Fed rate cut might be too little to notice, but by the time you get to 3 or 4, something should be happening. And what you see is in the soft landing cases, in other words, if you do 3 or 4 rate cuts and stop, the market takes off. The stock market does quite well. It's up about 14% over this period. If you have to do more than that, you're in trouble. It has to be either the soft landing, 3 or 4 cuts, or that's not enough to get some reaction. That's not enough to see that money supply number flow through the financial markets, then we have to start to worry. But I'd say right now, the market's more consistent with the top line on this chart than anything else, so far so good. Now the consumer is probably going to slow. We grew at a 4.6% annualized pace in the second quarter in terms of real consumer spending. It's already started to slow down in the third quarter. But the question is, does it slow to +2 or -2? And if you look at what's happened recently, you get these quarters that are 4% or so, and then you slow down, but you don't contract. And I think that's still the base case with the labor market situation that we have. Inflation's also remained quite low. This is the core PCE deflator, so I hope the FOMC's right. They don't have to do anything next year, but if they need to, there is some room with the PCE deflator still below 2%. Also, if we look at the producer price pipeline, so the blue line here is finished goods less food and energy on a core basis to take out some of the commodity influence versus crude goods, crude being finished by 12 months to get a sense of where we could be over the next year. And again, we're going down, not up on this series over the next year, looking at this lead. So there's room should there need to be an additional policy adjustment. This is the wage picture. So the blue line is average hourly earnings. We're using production and non-supervisory workers because we like to look at the pay of workers who make hourly wages when looking at this series. We're looking at the NFIB series, which asks companies if they plan on raising wages. That's the leading indicator. And at full employment, it should be moving up. It is moving up. It's just moving up quite slowly. So wage growth has been moderate. If you needed an additional insurance cut or something of that sort, I don't see the problem here early next year. Supplier delivery times also slowed back down. So this is a subcomponent of the manufacturing data that we look at. And about 18 months ago, we were starting to see some evidence of bottlenecks. So this series, the blue line goes up when we slow down our supplier delivery times. So when we're developing some sort of strain on the system, you would expect to see this series rise. And it was a year and a half ago. But given the slowdown in global manufacturing, because trade does matter for manufacturing, we've taken out any pressure that was in the system from this. We actually dipped back into contraction territory 2 months ago on the supplier delivery times index. And so you see the December pause that the Fed has told us about this week. The simple point would be there's more room to go in 2020 for this particular topic, which is trying to achieve a soft landing. Whether we're talking about whether the Fed can dig us out of a recession, maybe not, but I think this is achievable. So again, we're sandwiched on the top by the investment numbers, which we have trouble making too strong. We're sandwiched on the bottom by the consumer numbers, which we have trouble making too weak. Inflation in this world has come down. That is giving some policy room, and markets are still working. And so we're taking that as an optimistic sign as we work to next year. So the soft landing watch continues. Some of the international data is trying to bottom. Germany is particularly interesting to us just because it's been in the middle of everything the past year. It was affected by the China slowdown, it was affected by the trade war, we were threatening the EU with auto tariffs, it was affected by Brexit. And some of the German data, the IFO, the ZU, the PMI, are starting to put in some floors. So that's important to us. Even if the US data is underwhelming at the moment on a forward-looking basis, we could have slower job growth, but if it does not contract, recession is not the base case. There's room for policy to adjust. So I see the world at the moment, but let me take the rest of the time and we'll answer any questions that are here from the audience. Thank you.
Thanks, guys. Don, question on your presentation. So, with respect to that bottom part of the sandwich, the consumer, you highlighted a few important charts there. You're starting to see payroll growth slowing, which is starting to be offset by wage growth. You're starting to see that come through, and that's supporting income growth and spending. But typically at this point in the cycle, wages get to a point where it impacts profitability. So I guess my question is, you know, what level of wage growth concerns you to the point where that component that is supporting income growth starts to fade?
Yeah, thank you. So I'd say among our clients, the most bearish clients, the most negative clients like to look at before-tax profits as a share of GDP right now. If you look at that chart, it says profits are flat, GDP's up. So this series is going straight down. If you look at before-tax, national accounts profits as an example here as a share of GDP. However, we had a tax cut 2 years ago. And if you look at the same series after tax, it comes from the government, it's the same table. We're not making this up. The after-tax series as a share of GDP looks a lot different right now than the before-tax series. So we can debate the merits of the tax cut, just from a basic point here, say that I think you have to look at the after-tax series in a world where the tax cut has been so important recently. And so I think all of this is consistent with the slowdown. It's hard to add 200,000 jobs a month with the unemployment rate where it is, at 3.5%. We believe we're at full employment. We don't think you need much more than just over 100,000 to keep the unemployment rate flat. So some of this is the part of the cycle we're in, and wage growth should be rising. Typically, you've seen wage growth rise to about 4% on the non-supervisory worker series before a recession. It usually lasts for a couple of years. I don't think that's magic. Really 2% inflation and 2% productivity that would give you a threshold for what you could tolerate. So we're moving in that direction, but we're not quite there yet. So bottom line there is, I think there's time.
Let me just add in that you know, it's pretty clear from our analysis that the tax cut, which was supposed to lower costs to the consumer, to the business sector and lead to a boom in capital spending, what they actually did with the money was they paid their consumers through lower prices, and they paid higher wages, and it all went to the consumer sector, and the consumer is the one that benefited from it. Well, so that was from the tax cut, exactly the chart he's talking about, the after-tax, but that's over, right? So now you're in the phase of the cycle where all the things we thought were going to happen a year ago are probably going to happen this year. And that's the downside risk to the economy. I don't think it's substantial, but that's the downside risk.
I have my own microphone. This is a question for Michael. The trade tensions with China were about two issues. You covered mostly the merchandise trade effect on the U.S. and on inflation in the U.S. But speaking for myself, I thought the real issue was intellectual property and the treatment of foreign companies in China. And most economists really felt that was a more important issue than a bilateral trade deficit.
Sure.
What's happening there? Are the Chinese going to give up their economic development model and play by the rules?
No. Nobody's going to make a change on either side. No one's even really discussing. I mean, this agreement, if it turns out to be what we're currently talking about, which is we roll back tariffs some and they buy more agricultural commodities, the purpose of that agreement is to kick the can beyond the election. Once you get beyond the election, whether Trump takes a stiffer stance on intellectual property and things of that nature, well, that'll be a good question. But the reality is, if you wait a year, Huawei's got 5G, and the rest of the world's using 5G. The Chinese are on a warpath to replace U.S. technology in China. The newest Huawei phone uses no American components. Because it turns out there are people in South Korea, the Netherlands, Taiwan, etc., that are quite willing to sell technology to the Chinese. So, I think the Chinese have been playing for time all along in this, and that every literally month that goes by, they gain greater ability to compete on all these fronts. And so, giving them a year at this point, it's almost capitulation. I think it's unfortunate that none of these things have been addressed, but they're not being addressed. And I just got back from China. There's nobody in AmCham or those type groups over there, the Business Council. There's none of them that are optimistic that anything's going to be done in a 12-month time.
You guys both focus mostly on China and the U.S. It seems like Europe's like a sleeping giant, and yet the question is the engine petered out right now? There's Germany, France, and now Brexit, we just had a vote yesterday, very amazing vote. It's hard to imagine that Germany's going to sit by the sideline. And if trade deal occurs between the U.S. and China, it seems that Germany would be actually a major beneficiary.
Yeah, I would agree with that view. And next, yes, okay. So the way I look at the world is not as a U.S. economy, a European economy, and a Chinese economy. I look at the world as the U.S. as the suburbs. That chart showed they were the 59,000 earners. They're all about education, healthcare, high-end services. The competition in the world is between China, which is Atlanta, Phoenix, Dallas. It's the Sun Belt. It's the new, cheaper technology. And Germany, Japan, which are the Rust Belt. Detroit, Cleveland. So who does the best in an upturn? Well, the Rust Belt does the best off the bottom. Over time, the Sun Belt always does the best in every cycle. But it declines less and it rebounds the least. The Rust Belt goes down the most, which is where they are now. And this is not just Germany. This is Northern Europe. This is Northern Italy. They'll rebound the most. And so we look for weaker dollar, stronger euro, stronger rebound. And it's not just China. It's China plus Brexit plus the German auto situation. I mean, to me, they're looking really good for the next year, which is why I think we're in a global upcycle and I wouldn't bet against it for 18 months.
Yeah, I think Germany's one of the best leading indicators right now because it's in the middle of so much. It had its own domestic problems, the auto regulations that came into effect, along the Rhine River, and you were dealing with China trade plus tariffs plus Brexit. You're starting to bottom if you look at the PMI, so that's encouraging.
The number of questions seems to decline as lunch approaches, I suppose. What do you think the effect is and will continue to be from negative interest rates in Europe, and do you see that spreading further?
Christian?
Look, I would say 5 or 6 years ago, I would have argued negative interest rates probably shouldn't exist. But they do. They replace the zero lower bound with an effective lower bound. To some extent, I thought of negative interest rates as like the fee at the ATM. So I go to get my cash, and it's not my bank, I have to pay $2. And I don't like that. That annoys me. But I still might do it. And that's some sort of convenience fee. And so and I think part of the point is, if you wanted to think about what the alternative is, you'd have to truck around physical cash rather than participating in the economy as it is. So I think it was the FT, they ran an article, how many euros fit in different things. So how many euros fit in a suitcase, how many euros fit in a truck, how many euros fit in a hotel room. And once you get to $1 billion, talk about a company, it is really hard to physically transact in cash. So I think some of the small negative interest rates could be thought of as an effective lower bound rather than a zero lower bound, meaning there is really not an alternative to being part of that system. There could also be some regulatory requirements that are playing in there. But I might watch Sweden next week. The central bank there said they're interested in getting out of the negative rate position, and let's see if they can do it. The inflation number this week went up a tiny amount, but enough to probably give them some cover if they want to give it a shot. I think that'll be an important topic.
Do you think that policy is even working as a stimulative? Oh, sorry.
This is why we have a college of central bankers. They're way smarter than us.
No, just to add a small word on the other interest rates. I think we have the confirmation in Europe that it does not work so well for a number of reasons. First, you cannot apply negative interest rates to a number of liabilities in the balance sheet of banks. That's individual, whole household deposits, even SMEs deposits. So the transmission is really not good. You transmit via financial market to a certain extent. You cannot transmit to a lot of the liabilities in the system. So the effectiveness is more. Second, it seems to have an effect which is exactly contrary to the objective of the central bank. To take one example, it really looks like, especially in Germany, but not only in Germany, it's even starting in France also, but in Germany, the typical household would react by even spending less and saving more. So when you cut rates, the reaction of the average German household will be to say, okay, then if my savings are reduced by negative interest rates, I need to save even more to get the loan that I wanted to get from my retirement or whatever. So in effect, each time you cut rates, you get less spending and more savings, which is really exactly the opposite of the objective of the central bank. And there are other reasons of the kind, so that I think really the ECB has reached the frontier of what we could imagine doing in that direction. They will, I don't think they will try to do more, but to some extent they are trapped because they moved suddenly from -0.5 to 0, then it will be interpreted by the market as a strong tightening, and that could have a negative effect. So they are more or less stuck there until conditions. The real problem in Europe, I think, is the fact in the Eurozone, is the fact that part of the Eurozone, especially Germany and the Netherlands, have a very strong surplus of the current account. And that's because they are saving too much. whether it's private or public, doesn't matter. They're saving too much and not spending enough. And overall, we also so that's really what is the anomaly that should be corrected. But it's difficult because it's cultural as we know. As a matter of fact, there is one encouraging sign. There is that the Netherlands have started to significantly increase public spending and try to increase private spending by considering tax cuts. So there could be a model coming from there, but in Germany it's really difficult. Although since they have stopped their nuclear facilities, for instance, they need to invest hundreds of billions in green energy. They are doing some, but they could do 10 times more. And that would be a necessary investment for the future. So it's not simply throwing money out of the window. It would be really increasing the productivity and increasing the long-term potential of the economy, because they will have to stop their coal plants. The sooner the best. But it takes time to convince them that they should not stick so strongly to their zero deficit policy.
I can't tell you how many times in the past year I've been reminded that the words for debt and shame are the same in German.
Good day. Great to see you guys here. My question is more from the sociological side. I particularly suspect, Michael, that you'll give us some insight. But while I certainly agree with Dennis that central bankers, for the most part, do have big brains. But I think most are under an environment where I think a lot of them are feeling like they're under house arrest. While the walnut-sized brains, which seem to be what I think we're all seeing, certainly an abundance in the U.S., but certainly around the world. And I'm curious because I think one of the things that at least from my perspective, spending so much time in Latin America, as some of you know, I'm the consul of Chile here in Philadelphia. I was just down in the area, recently going through Hong Kong, recently in Singapore, and there seems to be a sense that that the inability of countries and economies to deal with the needs of their citizens and is only going to continue to increase. In Singapore, I was meeting with some very high-level people in the government. They felt that they were maybe 10 years away from Hong Kong. And not talking about the political, but simply in terms of the aspiration. And one of the things I suspect, and certainly the disconnect between central banking, at times through the general populace like me, is helping us understand that not just the complexity, but also the reality of the disparity and the sense of growth on a personal level. So the question, it's sort of more, Michael and Don, I'd appreciate your comments, less as economists, but more from a sociological standpoint. Are we going to see, I mean, Chile is extraordinary. I mean, are we going to see more Chiles on the street? Is Trump simply a reflection of societies not being able to address the needs of the people, et cetera? It's fairly wide open. Always enjoy your comments.
So I mean, if you're Donald Trump or a politician with a nationalistic view like Donald Trump, and a lot of places in the world, you see what happened in the UK last night. You got to be thrilled. I mean, that was supposed to be a dead heat election, and it was a walk away for Boris Johnson, and he walked away by crushing Labour in what they call the red wall, which is very much the way Trump won by crushing what we call the blue wall in the United States, which is basically your blue-collar, older workers. Now, in a lot of places in the world, like Chile, like Hong Kong, I was just in Hong Kong this weekend for the demonstrations, it's not the older, sideline worker that's upset. It's the younger worker who just doesn't see a way out. But I think, yeah, in general, we're going to continue to see issues. For me, part of the problem is, in a truly open global economy, the money tends to move to where it gets the highest investment return. In the world today, that means that money should be moving to Asia, to the ASEAN, where the education is the best, the workforce is the strongest, the growth prospect is the best. It's not. And it's not because, to put it bluntly, they speak funny languages and they don't look like us. And in particular because a lot of them are Muslim. In Bangladesh, in Indonesia, Malaysia, places like that. Until capital gets over the limitations of where capital should flow, the reality is that from 2000 to 2015, it was a no-brainer. You went into China. China, if you could design a place that is where you wanted to put money, China was it. A 1.4 billion person, almost completely homogeneous environment with one language, one set of rules, and run by a totalitarian government which controlled things and made it easy for you to deal with one person, with no second committee to have to deal with. And so that's what you did from 2000 to 2015. By 2015, China's getting too expensive for some industries, and they're going to have to move. And as they look around and they move and they go to Indonesia and Bangladesh and Myanmar, places like that, it's just a lot harder. People talk about Vietnam. In Vietnam, the communists are real communists. They will put down tools and not work. And companies that have moved there, some of them are moving back already because they're discovering the difficulties. So no matter what happens in the next 10 years, the growth rate of the world, even in a completely free trade environment, is never going to be like it was from 2000 to 2015. That episode was unique and is now over. So if there's global resistance to growth relative to the 15-year history, people aren't going to be happy. People are not happy in the United States with 2% growth. They're not happy in Europe with 1% growth. They're not happy in Japan with 0% growth. They're not happy in China with 5% growth. They're not happy in India with 4% growth. I mean, no one's happy that I've seen. And I travel a lot. So, I mean, yeah, I think things will get grumpier before they get better, and that's on politics, I think, more than anything else. Wish I had a better story. I don't. Boy, that got a lot of hands. Let's go to the chairman so I'm not in trouble.
Chairwoman.
Chair.
Chair. So anyway, I'm sorry, Don, perhaps you wanted to say something, but what you are describing is essentially secular stagnation a la Larry Summers, in the sense that there is a dearth of demand, and you don't have enough investable vehicles, and as a result, I'm sorry, there's too much demand, but you don't have enough investable vehicles. So as a result of that, you have very low inflation in the goods and services. The inflation story, you see that in asset prices because of the fact that capital is not moving to these productive environments.
So
Is that fair?
I would argue that Summers' secular stagnation is more the American Western civilization concept, where we're so close to the production frontier that there are not big gains in productivity available. My problem is that I tend to agree with our good friend Catherine Mann's view that she developed at the OECD, that there's a lot of places that are well back from the frontier of productive capability, but they're not getting the money they need to move to the frontier. And that, to me, is the essential problem in the world today, is that the capital is piling up at home, and there's a home bias in investing. And this is why you have negative interest rates in Europe, is you know, if I had negative interest rates, I just go someplace else, right? But if you're a pension fund in Germany, you're not allowed to just go someplace else. There are requirements that say that you have to own so much in local sovereign bonds. So there's money that's stuck, and it's not moving to where it would get a higher and better use. Until that changes, I don't see a lot of optimism on global growth improving. No. Do I see it regressing? No, because the problem's there, and it's as bad as it can get. The money's not moving. So you're stuck at this lower growth rate. How long can that last? Rome declined in 700, and the Renaissance started in 1300. They called that the Dark Ages.
That's even worse than the cartoon.
You can go sideways for a long time.
Yeah, I just say on the tax cut, there are two parts of the tax cut 2 years ago, the consumer part and the investment part. The consumer part, it's hard to see why you'd want demand side stimulus of whole employment. I think the hope on the investment part, the capital part, was that you were going to get some supply side effects. And I think the most disappointing chart is that CapEx has been so flat for the past year for that reason.
Let me ask a question of two chairs and a third chair and a reference to what Kathleen just said. Many years ago, Kathleen and I worked together on a book, and that book discussed integration, cooperation, dialogue, interdependence, financial relationships that suppressed, or political relationships that suppressed belligerency and encouraged openness and transparency. This organization, I remember introducing Paul Volcker when he launched an initiative on worldwide transparent global accounting standards. That was a long time ago. That process was in the Art Museum in this city. Kathleen has just asked and described, and you have just described, protectionism, barriers, impediments, dependence, oligarchs, and a whole other list. And we're all worried about it. Here's a question I have for you. We have this wonderful new initiative in the Global Interdependence Center. It's the only place in an organizational structure where folks who were central bankers in the world can speak to these subjects from their platforms. What is the role of the Global Interdependence Center as it confronts this new world that has just been described over the last couple of hours and summarized by its new chair, Kathleen Stephenson?
I can go first. So I'd say I think I know what it's not, which is to keep putting up pictures of dead weight loss triangles and expecting that to make a difference. There's a good reason to believe that trade impediments, as an example, can affect growth. But that argument seems to have not mattered in the past 2, 3, 4 years. So I think we have to find a new argument that does matter, and I think this platform will be a big part of that.
So I would say that our role is to make sure that the global interdependence that developed from 1976 when this institution was started through now continues. And that part of that is having the dialogue with everybody, everywhere in the world. I travel a lot. I was just in Ireland, London, and Brussels. And when you're in Ireland, you're in Ireland. And when you're in London, you're in London. You're not in the UK, you're in London. And when you're in Brussels, you're in Brussels. They're not part of the EU, even London, which is a league. I mean, we do an annual in Spain. We've done one for the last 2 years with Bundesbank. When you're in Germany, you are in Germany. When you're in Spain, you're in Spain. It's important to get out and travel internationally and communicate with people and talk to people and bring the rest of the world to the rest of the world, and to bring together the people that do that and travel. One of the things I'm most excited about is our conjunction with SWER, which is a group very much like the Global Interdependence Center, which operates all across Europe and does about 8 conferences a year, I think, over there. I've been to a couple of them, and they're very interesting. They're also very European. I just got back from China. I traveled to China a lot. I talked to AmCham groups there, and they're very interesting. They need to hear about internationalism, but they're still very Chinese. I mean, American businesses doing business in China are very focused on China. So to me, one of the essential roles of GIC is to keep working on that network, keep bringing the groups in each one of those countries that is as broad as it can get, and try to make it broader. Because only in bringing that communication to others are you going to get the connectivity you need to break through.
I think we're out of time. Let me say thank you to everybody. We can continue the conversation